Hey everybody, and welcome to your top producer interview class. It is Friday, the 13th of February, 2015, and I am honored and privileged to have an opportunity to interview awesome top producing loan officer down in the Houston, Texas area. I've got Mr. Rich Bonn from Leader One. How are you today, Rich?
Doing great, thank God.
Awesome, awesome. So Rich is joining us. He's I know you've worked with and around Chad. How long have you been around Chad and working with Chad off and on through the years?
I believe that this year is completing my 5th year working with Chad.
Okay. So you've known Chad for a little while.
That is correct.
Awesome.
It's been a great privilege.
Well, and this is Rich. He's out of, like I said, Houston, Texas. Rich, tell us a little bit about yourself. How did you get into the mortgage business? How long have you been in the mortgage business? Kind of give us a little, who is Rich Bonn?
I got into the mortgage business straight out of college, kind of through a back door. I was working at a major bank as a teller, got promoted up to branch manager, and then was quickly yanked into commercial loan underwriting. Found that that wasn't my place. And while I was looking for something different, I decided to try mortgage origination on the residential side. I enjoyed it quite a lot. Was working with a subsidiary of IndyMac. I went into their underwriting and product development areas and started writing guidelines. Became a wholesale rep, and then after IndyMac left us, I went back into residential mortgage origination. I've been doing that ever since.
Oh, awesome. Have you been in Houston, Texas that whole time?
I've been in Houston since 2002 or 2003.
Okay. Where's like your home bay? Like, where do you consider like your home spot?
Well, Houston is definitely my home. I was born out in California, but just the people out here in Houston and the atmosphere in Texas are amazing, and I can't picture being elsewhere.
So you were born in California, but Texas is home.
I was born in California because my parents had a bad sense of geography.
I like it. I like it. Well, this all kind of stemmed from a couple of weeks ago. You had called me about a really cool strategy that you had just begun implementing, and you knew that we have this group, the Mortgage Mastermind Group, and as part of Leader One, that's part of your benefits package. And you asked, hey, would this be something that the group would benefit if I shared this with them? And you kind of broke it down for me a little bit, and I didn't really understand at first what it was that you were explaining to me. But then as you started to break it down further and further for me, I was like, oh my goodness, this is absolutely genius, and I would be thrilled if you would share this with the group. So if it's okay with you, you kind of dive into the strategy a little bit now?
Sure thing. It's a fairly simple strategy. Basically what has happened is there's a product, the FHA Streamline refinance, and it's something that's really fallen out of use over the last 15 or 20 years. First, because FHAs were not so popular during the previous mortgage boom, and then secondly, because the administration had increased the mortgage insurance premium so much that it really didn't make sense to do streamline refinances or FHA to FHA refinances on any existing FHA loans. The costs were onerous. With the early January announcement of the reduction in the mortgage insurance premium, a lot of these loans, a lot of these refinances, people who would like this opportunity that were sitting on the sidelines, they became viable prospects for great money-saving refinances. So what I did, first, of course, I went and looked through my database for people I could help, but then also I decided that I'm really not so energetic at times. I like to help other people, especially if by helping other people, I can bring value to others, and eventually the value will trickle back to me. So as tax time is coming up, I know that a lot of my friends who are tax preparers and CPAs are getting people's 1098 INT forms as they're doing tax preparation. And I realized that this presented a great opportunity for them to provide value to customers by educating them about this opportunity. So what I did is I crafted an email, and I sent the email out to my tax prep partners, my CPA partners, and I followed up with a phone call. And basically, I explained to them what is going on with the finance, with FHAs, with FHA loans, and I sent them out my customer application package with this email. And as I discussed this with my tax preparer partners, they were extremely excited about it. The reason why is a lot of times they're trying to compete with the big names, and they're trying to figure out an additional value other than tax preparation, and this is a great way to give a concrete savings to their customers where their customers can pay their, basically recapture their tax prep fees in a month or two, and it puts their customers in a better position for the future.
The long-term future, and it's painted very beautifully in the email that you've crafted here, because it talks about what's happened, and then it gives a very specific benefit with the way that you you gave a testimonial without including somebody's name or without having somebody leave the testimonial for you. It's what I like to call a hero story, Rich, and where you go, one of my customers who has it, and you paint a very specific picture about a real scenario where you were the hero and were able to save that family $260 a month.
Absolutely. And
I think that goes a long way, and that catches people's attention because that, that's close to my scenario. My home is $220,000. I wonder if I could save that money too. So it does a lot of things with that one little piece right there. I love the way that you crafted that kind of a hero story within the email, and that gives the benefit right there.
Thank you. Part of what we have to do is we have to communicate the benefit and do it in a tangible way. And while most CPAs and tax preparers are intelligent people who can figure this out, we had to make it simple. We had to basically create applesauce out of the apples so they didn't have to chew it over too much, and they could just get the essence of what we're speaking about.
Well, and what you've done here is there's nothing really self-serving in this email, and so you've created something that they're licking their chops about because they know it's a major benefit, and they always, just like everybody else in business, want to provide their clients with something valuable. But it's done for them. They don't have to think about it, just forward it on. I love that part. It makes it super easy to implement.
Well, and that was the plan. The second thing that I did is I'm in touch with my realtors fairly regularly, and I like to keep the realtors that I work with abreast of changes to guidelines that will help them make their job easier or keep them from sticking their foot in the ground, sticking their foot in the wrong spot. And one of my realtors said, Rich, I would really like an email about this. So what I did was I took the CPA email and I recrafted the email just a little bit and sent it over to one of my realtors. And she sent it out to her database, and she received a bunch of phone calls about it. But what was great was she actually received 3 listings off of this email. Now, this email doesn't mention selling their house. It actually mentions nothing about it. This is not an email from the realtor saying, hey, do business with me. This is a realtor saying, hey, do you want to save money?
Here's something valuable, Mr. Client, because I care about you. I care about you.
Exactly. And when this email went out, what ended up happening was it was a reminder to that customer about their relationship with this realtor. It showed that the realtor cared about them. And so this realtor's got 3 listings and potentially is going to also have 3 purchases once these listings are sold or they're up and running.
Mm-hmm.
So this is a huge benefit to the realtor. And so I took this and I was like, wow, this is not a terrible idea. And I asked the realtor if she minded if I shared it with a couple other people. She said, no, that's fine. So I've shared it with other agents. What I did was I put up a Facebook post. And the Facebook post said, hey, I've got this email that I sent out, or that I gave to one of my other realtors. The realtor sent it out and was able to pick up 3 listings. If you're interested in this, give me a call or message me. And I had a few agents who I've not really interacted with stick their hand up and say, hey, yeah, I really want this. So it gave me the opportunity to engage them. We've had one-on-one meetings or phone calls. I shot out the email to them, and they have shot out the email to their database. One realtor in particular, who I just met with on a Wednesday, after he shot this out, he was so happy he asked me to prepare another email about another product niche that we have, which he's going to shoot out to his database of just over 1,000 people.
It's awesome.
And the nice thing is he's shooting this out, and he's shooting. I wrote it from his perspective, referring people to me because that's what he wanted to do.
Perfect. And the thing is it's about sending out value. Everybody wants to do it, and the agents see that they have something different to send a value that is not self-serving. It's not about salesy all the time. That's why we talk about it. Rich, one of the things that we go over all the time is ways or excuses, reasons to follow up, reasons to get in touch, reasons to get face-to-face, and it can be any reason. It can be, a cool FHA Streamline thing. It can be hey, I'd like to sponsor your next open house. It's any reasons, and I love that you've come up with a reason and given yourself an opportunity to get face-to-face and develop those relationships, and it's far beyond just the meat that happens with the actual email and creating refinance opportunities for you. It's all the other personal branding and that relationship building that you're doing that goes with it that really is going to make the overall difference in the success of this strategy, because it's far more than just getting a couple of refinances of FHA mortgage holders. You're building relationships with your referral partners. You're helping them build relationship with their client database, which makes them happy, and now they're happy with you. And guess what happens the next time they get a buyer lead? Hey, you got to call my guy Rich.
That's exactly it. And the nice thing is that very rapidly I was able to show results to other agents based on the first agent who asked me to craft the email serving as a test lab. We sent it out, and the agent had results in less than a week.
Well, and it's perfect. And so let's kind of recap what we just talked about so far, folks. So what's happened is Rich had a really cool idea to get refinance opportunities with current FHA mortgage holders because President Obama or the administration changed the way that mortgage insurance premiums were being I guess lowered the rate on that, so he knew that there was opportunity with that product. So next, Rich wrote an email letter explaining what the benefit of that recent FHA MIP rate decrease was all about, giving a very specific example or painting a picture of what that would actually look, or what it looked like, his hero story, so to speak. The next thing he did is he just sent the email out to some CPAs and tax preparers that he knows and a couple of real estate, or specifically one real estate agent that he knows, and he follows it up with a phone call explaining what that benefit is. That gave him an opportunity that they would get that out and make some money in refinancing. Rich made a little bit of money on the refinance and saving that family $260. There's a couple of wins there, and that's pretty cool that he knows that the loan program part will work. But the real estate agent partner gets well, I put 2 listings. It's actually 3 listings from sending something of value to their past clients. That's the basic gist of what we've gone over so far, right?
That would be correct.
That's a pretty doggone simple implementation strategy right there. I mean, that's pretty simple stuff.
The one thing I would say is I actually fronted the email with the phone call rather than sending the email out first.
Okay.
Okay.
So
And
you
the reason
called
that
them first and told them what was happening, and hey, I got a cool email that can produce some results for you.
Correct, because the other thing is we all get a number of emails a day. I'm averaging somewhere in the neighborhood of about 300 emails a day. And I wanted to make certain that they were looking for it, and this was a reason for me to call them, engage them, see how everything was going. Now, with CPAs and tax preparers, of course, the conversation had to be less than about 3 minutes because they're in their busy season. Mm-hmm. But this way, at least, they were ready for it.
I like the idea of that, and we've gone over that on our classes before. The average adult in America gets 147 emails a day, and you know, I don't even gulp to hear somebody say they get 300 emails a day. It is what it is, and so I love the idea of calling first and then following with the email, because that way you're preparing them. You're kind of, hey, heads up, look out for this really great email that's producing these kind of results for some of my partners. Love the idea of that. All right, so I'm sold on the strategy itself, but I'm brand new to the mortgage business. I've never done a FHA Streamline loan before. How does this work, Rich? How do these loans work?
Well, there are 3 different varieties.
Okay.
You've got a actually, if you can put all 3, because I think I want to do them in reverse order.
Okay.
The first one is a non-credit qualifying Streamline without an appraisal. This is kind of cool. No income documentation. We don't care about debt-to-income ratio. Depending on the lender you work with, you may or may not need to verify employment. All you have to do is document the assets for the cash to close. Now, why is there cash to close? If there's not an appraisal and you're not credit qualifying, then you can't add in the closing costs to the mortgage. Okay. We'll get to that in a little bit. Then I'm going to go to number 1, credit qualifying. This is just like any other mortgage that you're doing, any other refinance, income, assets, appraisal. But here's something kind of cool. And you're going to have to check with the company that you work with as well. Let's say, for example, they purchased a home for $200,000 and they owe $180,000. The appraisal comes back, God forbid, at $150,000. Normally, you'd be dead in the water. But the FHA guidelines will permit you to set the appraisal aside. You don't have to use that appraisal. You can actually use the acquisition cost of the property instead of the appraised value and keep going, because this is going to be a benefit to the borrower. So
and is that the main thing that you have to, I mean, that's like the main part of that piece? I don't know loans, and it's obvious with this question, but is that the main piece, is the last part that you said? I drew a blank there on asking the question, but the last part that you had said was that as long as.
Well, the setting aside of the appraisal.
Yes.
Yeah, so I mean, that's a huge thing, and that would be the only reason why you would pretty much use strategy number 2.
Okay.
Non-credit qualifying without non-credit credit qualifying. It would be credit qualifying without an appraisal. Excuse me. That would be the only reason that you would use that strategy, is because you were doing a credit qualifying with an appraisal, and what ended up happening was the appraisal didn't come in. If the appraisal doesn't come in, you put it to the side and you keep going. So that's the benefit. You either, if the borrower can pay cash for their closing costs, then they're going to be in great shape. They can do option number 3. If the borrower can't pay cash or chooses not to, and they have enough equity in the property, you go for number 1. Either way, you're going to be in great shape, and you need to show that this is benefiting the borrower.
And so
we've got a couple of things we have to look at. First and foremost, if the outstanding mortgage has been had less than 12 payments made, all payments have to be made within the month due. Now, I'm going to throw in a couple of other caveats here as well. First and foremost, the mortgage that you're refinancing, the borrower must have made 6 payments since the loan has been originated, and the loan has to have been outstanding for 210 days prior to receiving a case number. So if the loan has not been outstanding for 210 days or the borrower has not made 6 monthly payments, either of those scenarios, you will not be able to get a refinance authorization from FHA. If the loan has been outstanding, can we go back again?
Yep, sorry.
If the loan has been outstanding for 12 payments or more, we just need to make certain that no more than once during the last 12 months can they have had a payment that was made more than 30 days late, and within the last 90 days or the last 3 months, all payments have to have been made on time. Okay, we can go ahead.
Okay.
So now let's talk about how to calculate the loan amount. If we're not doing an appraisal, then you are not allowed to increase the loan above the existing principal balance except for the following items. You can add the new mortgage insurance premium less the refund of the upfront mortgage insurance premium. So for example, let's say you've got a $150,000 loan, let's say it's a $100,000 loan to make the math simple for me. On that $100,000 loan, you're going to have a $1,750 mortgage insurance premium. But the borrower has a refund of $800 from their current mortgage insurance that they have with the FHA. And you're going to find that on your refinance authorization when you get your case number. So then your new maximum mortgage amount is going to be $1,750 less the $800. So now you're looking at so you're going to have the $100,000 plus $1,750, so $101,750 minus $800 plus the accrued interest for that month.
Okay.
Okay. But it cannot include delinquent interest, late charges, or escrow shortages. One other really cool thing is that there's a form that you have the borrower sign when you're doing your disclosures that instructs the previous lender what they're supposed to do with the escrow account. So you can potentially roll over the escrow balance from the prior lender to this loan. What that does is that decreases the borrower's cash to close if they're using a non-credit qualifying product. This is a really cool little niche. And a lot of you lenders out there are going to say, oh no, we can't do that. You may have to talk to a manager when you're getting a payoff, but it's something that I've been doing for quite some time.
Very interesting way to do that. Joy's asking if you can repeat where we get the MIP refund amount.
The MIP refund amount, when either you or your processor get the case number from FHA Connection, the MIP refund amount is going to be on the case number certification with the refinance authorization.
I'm sure it's just prorated based on the date when you do it.
That's correct. I think the first year they earn something like 40% of the MIP, and then it decreases from there.
Okay. But is that clear and easy to find when you're doing one of these?
I believe it's on the second page near the bottom. it'll say MIP refund amount.
Okay. So it's clearly marked. Okay, perfect. Now, the rules are different with an appraisal and without an appraisal. So what are some of the scenarios how do you calculate the refinance amount with an appraisal?
Okay, if you have an appraisal, you can increase the loan amount, the outstanding principal balance, by the upfront mortgage insurance premium less the refund of the previous premium, plus closing costs, prepaid items to establish the escrow account, and the new upfront mortgage insurance premium. And it's got to be the lesser of that, or 97.75% of the appraised value of the property, plus the new upfront mortgage insurance premium. Okay, you can include interest charged by the servicing lender, but delinquent interest charges, late charges, escrow shortages, and discount points cannot be included in the new mortgage. So if somebody wants to buy down their rate even further, they're going to have to come in with that part cash. Does that sound clear to you, Paul?
It is. It is. I'm just kind of scanning through to see if there were any questions that I had, and I was kind of pausing to see if anybody had a question on the call. And it looks like that's it's pretty clear, and I hope everybody kind of gets what those regulations are. And okay, so if somebody needs to review what you just went over in terms of these regulations, where can they go to find this?
Okay. One of the nice things that Leader One does is they give us a subscription to All Regs.
Okay.
And I spend a lot of time in All Regs. It's a great tool. They can go into agency guidelines and check out the HUD 4155.
HUD 4155.
If you take a look at this slide, it actually has exactly where it is. 4155.1.3.c.3.a.
Perfect.
That is where the guidelines are.
Perfect. Awesome. Now, I know one of the things you mentioned as being a very vital part, and the way that you structure these is you mentioned it's called net tangible benefit test. Tell us about how does that work? Is that something that has to happen with every scenario? Is that something you do with each and every lead that you get in? Is this something that happens after you've got a filled out, you've got a lead has turned into a client and you're working on the process?
Well, generally speaking, you want to make certain that what you're doing is benefiting the borrower. FHA has set the hurdle kind of low, but I'm going to give you a couple scenarios of what the net tangible benefit test is right here, and then you'll be able to see on the next slide from the 4155 other tests.
Okay.
So, for example, if you're going from a fixed 30-year to a fixed 30-year, the borrower has to have a 5% decrease in the principal, interest, and annual MIP payment. Now, I'm going to repeat that again. It's extremely important that you understand. It's a 5% decrease in principal, interest, and annual MI payments. Now, why is it important that I repeat that? Changes in taxes and insurance do not affect the net tangible benefit test. So, for example, if a person is refinancing, they're doing a Streamline, and their current principal, interest, and MIP is $1,000 each month, they have to save $50 a month in order for this to work.
Or for FHA to accept it.
That is correct.
Gotcha.
That's the minimum. Now, the other one is, let's say they're decreasing their term. Your payment may go up in this case. So long as you have a minimum of a 5-year decrease in the remaining term of the loan. So if it's an FHA loan that's been out for 7 years, and you're going from a 30 to a 15, then your you're chopping 8 years off the term, that's considered a net tangible benefit.
Okay, that makes sense. That makes complete sense. And now with the insurance or the mortgage insurance premium decrease, that if for fixed to fixed, which I mean of the scenarios, which are your most likely scenarios? 30-year fixed to fixed? I mean 30 to 30.
With most of my customers, we're going 30 to 30. A couple of them have looked at 30 to 15.
Okay.
But they've decided for cash flow and savings purposes that a 30 to 30 is probably better for them.
Have you run into a scenario yet that the client did not pass the net tangible benefit test, that the loan opportunity did not pass the test?
I have not. Based on what MIP or what mortgage insurance rates were over the last few years, just that decrease in the MIP has been enough to satisfy it.
Okay. And so it's most of the leads you get are going to be a real opportunity. And with the 3 different scenarios that you explained a few minutes ago, you've got 3 really great options. I mean, it's very few and far between that you don't have a real opportunity to refinance.
Correct. But then the question is, even if it meets the net tangible benefit test, does it make sense for the customer? Mm-hmm. So you have to take a look at that as well.
Absolutely. And here's some more net tangible benefit test scenarios for like adjustable rate mortgages. And how is that different than? I mean, do you have to move them from an ARM to a fixed mortgage?
You can go from an ARM to a fixed to an ARM, a 1-year ARM to a 3 or a 5-year ARM. But each of these scenarios is a little bit different. If you're going from an ARM to a fixed rate, you can't jump more than 2 points in the interest rate. If you're going from a 1-year ARM to a 1-year ARM, you've got that same 5% of the PMI and MIP. If you're going from a hybrid ARM, which is like a 5-year ARM, to a fixed rate, you've got to, during the fixed rate period on the hybrid, you've got to have that 5% reduction in principal, interest, and mortgage insurance.
Okay.
Each of these scenarios is a little bit different. I'm not seeing a whole heck of a lot of hybrid ARMs or 1-year ARMs that have been originated recently, so I think it's not the best use of our time to cover that.
I was going to say, are these real scenarios that are? I mean, they're obviously real scenarios, but in the day-to-day business, are you running into them? Probably not.
Not so much.
For fixed rate, though, those are definitely. I mean, those are the ones you're going to pay attention to. When you're going from a fixed rate to a fixed rate, especially a 30-year to a 30-year, right? That's like probably a vast majority of people that you bump into with FHA mortgages.
That's correct.
Okay, makes sense. But the scenarios are there, guys, and make sure that you know all the different regulations so that you can be efficient when doing these loans. Now, you had mentioned a couple of the pitfalls already to look out for. Specifically, have you had a scenario yet that one specific piece has caught you up and said, ooh, I want to make sure I pay attention to this for next time?
Well, the 210-day rule, actually, I smacked into this morning.
Okay. Okay.
It was like running into a sliding glass door. One of my customers had purchased a home, and they purchased it, had just made the 6th payment on February 1st, so I thought that we were clear. But because they closed on July 31st, we're going to have to roll this over 1 more month.
Yep, I gotcha. And that makes, okay, so that can catch you up. One of the things that I thought or foresaw being something that can come up is ensuring on-time payments for, I think you said, is it 3 months or 6 months? Well, if the loan is...
The loan has to have on-time payments for the last 3 months.
Okay.
And, also one other thing is when you're running credit, if you're not doing a credit qualifying Streamline refinance, you need to make certain that you're doing a mortgage-only report. You can do that with or without credit scores, depending on your company. If you know the borrower's credit scores aren't terribly good, but they've got a great mortgage history, when I say not terribly good, I'm thinking, 540 or something around there, but they've got a great mortgage history, then you probably would do it without credit scores, because most lenders are requiring to use 619 or 620 credit score when you're doing a no-score streamline. The other thing is you don't want to have the rest of their liabilities on the credit report because you're not underwriting for that. You don't want to give the underwriter information that they don't want.
And was my very next question is, do we need to concern ourselves that they bought a new car 4 months ago, or is that something that you've got to caution people that are interested about?
The big thing that you have to look at is whether or not they are whether or not the number of inquiries is dragged down their credit score. That's pretty much it. You want to make certain, once again, that the loan has been outstanding for a minimum of 6 monthly payments and for a minimum of 210 days. It has to meet both of those tests. Otherwise, you're not going to get a case number.
Gotcha. So about how long ago, when did you, I know this, this is pretty new stuff. I remember when they started, when Obama announced the whole thing. We're just talking a month into the year. It was early January when this all came about with the mortgage insurance rate drop. When did you start implementing the strategy?
I started implementing it on January 22nd.
Okay. So is that that's the day you made those first calls, or that's the day that first email went out?
That's the day I made. Okay. On the 19th, one of the realtors had called and asked me for the email.
Perfect.
So I sent that out to her, and then I started targeting CPAs on the 22nd, and then on the 26th, after I had received feedback from that realtor, I asked her whether I could share this with other agents, and when she gave me permission, I went ahead and started sending out the emails to the other agents, putting the Facebook up as well.
Awesome. So about the last
about 2 weeks.
Yeah, I was going to say last week of January, second to last week of January, so a couple of weeks. So we all, the story, we love hearing about helping our agents get 3 listings, and that's awesome. But aside from the 3 listings your agent partner got, what kind of results have you gotten personally on this strategy?
Currently, I've got about a handful of these in process, and I have 3 appointments, I believe, on Sunday to discuss this opportunity with other customers.
Perfect. Awesome. So already within the first couple of weeks, it's actually got loans in process as well as new leads that are coming in at the same time.
That's correct. And the other thing is that it's giving me, aside from immediate monetary results, it's given me interactions with realtors who have been challenging to get into their office and speak with them, and it's had other realtors raising their hand to talk with me as well.
It's perfect. It's giving you those opportunities to develop relationships. I got to tell you, Rich, I love the simplicity in it. I love the thought process behind it. And what's really awesome is that the way that you leverage it with your partners is that it's a benefit for their clients. And that's really the way that you go about it. And if you happen to get some leads off of it, that's awesome. But the reality is you're helping your partners get leads themselves from it. And that is always the best way to create and develop relationships, is to help others do what they want. Guys, girls, I know you on the call know the loan process a whole lot better than I do, and I probably asked some questions about the loan process that you wouldn't. You're like, oh, Paul, we know that answer. So are there any questions that you guys have that maybe I didn't answer, or questions, shoot the questions at us. Rich is here. He's more than willing to answer some questions for us. Looks like James has one. What about the upfront MIP of $1,750? What do you mean, what about that? Is that something that can be, I believe Rich had said, and correct me if I'm wrong, Rich, but that's part of what gets added into the new loan amount?
Correct. The upfront MIP can be added to the new loan amount, less the refund of the MIP from the existing loan. So once again, as we discussed earlier, if you have a $100,000 base loan amount, the upfront MIP would be $1,750. If they had a refund from their previous loan of $800, your new loan amount would be $100,950 plus whatever insurance would be accruing for the month, or interest would be accruing for the month, excuse me.
Okay. And that makes sense. And that's all. Those numbers, like the refund amount and the interest accruing for the month, are all prorated based on the date, right?
No. One other thing, and this is really important, is you do want to make certain that you schedule these to close to fund on, right around the last day of the month or the day before the last day of the month. Why? Because with an FHA loan, all of the interest for the month accrues on the first day of the month.
Okay.
So February, your payoff, February 1st through February 28th, is the same.
Gotcha.
Because all of the interest accrues then.
Okay.
So you want to close closer. You want to close and fund closer to the end of the month, so the borrower is not paying double interest. Yep.
That makes absolute sense. James is saying, I was under the impression that the 1.750% and closing costs cannot be added to the new loan amount. I thought you had said closing costs could not be, or it depended on which scenario they went with, whether or not closing costs could be added. If it was without appraisal, they needed cash for closing. But if it was, a regular old standard qualifying with appraisal, that closing costs could be added.
If you have a credit qualifying Streamline with an appraisal, closing costs may be added up to 97.75% of the loan prior to MIP, of the property value prior to MIP, but you cannot add any discount points. Closing costs, aside from the net MIP, which is the MIP less any MIP refund, can be added to a loan amount on a non-credit qualifying with or without appraisal.
Oh, okay. That's awesome. The only stipulate what I just heard was that you just can't buy your points down. Or if you do buy your points, you just have to do it with cash.
Correct.
Okay.
And remember that your borrower is going to have to provide statements to show cash for closing.
Okay. How many months? Is it just standard, like the standard 3-month statements, or what?
Standard 2-month statements.
2 months. 2 months. Gotcha. Okay. Great stuff. And it looks like, anybody else have any questions? Oh, wait. Streamline without appraisal. You say the MIP of $17,250 can be added.
The MIP less any MIP refund may be added.
Right. So they add it in and then they subtract out the refund from the previous, because it's a refi. You've got a refund from what you previously paid.
Correct.
Without an appraisal?
Without an appraisal.
Awesome. Awesome. So yes, James, that sounds that's the deal. So good stuff. And again, if you want to make sure, if you want to read up on that, I believe you said it was the HUD 4155 was where those regulations and where the documentation or the rules of the game basically are?
Correct. And specifically for, I'm about to give out a string of numbers and letters, specifically for the calculation of the loan amount, the maximum mortgage, it's the 4155.1, Chapter 3, Section C. That's where you're going to find all that information.
I wrote that down too. So if I'll post that on the private group, 4155.1 C3C. Got it. Awesome stuff. Well, Rich, thank you again so much for taking the time out of your day. I can't tell you how much we appreciate you sharing. I mean, this is such an easy and wonderful strategy, really easy to do, and it puts some really quick results in the book for you. That's what I'm like, wow. The results from this thing are so quick. Rich, I can't thank you enough for taking your time out of the day and sharing your knowledge with us. Guys, girls, do me a favor. Head on over to the Facebook page over at facebook.com/Mortgage Mastermind Group and give Rich a little bit of love and thank him for his time today and sharing his knowledge with the FHA Streamline and how you've really got a ton of different scenarios that for all reasons you should be able to, unless somebody's really having trouble paying their mortgage currently, you should be able to help them out and save a bunch of money on the life of their loan and help your referral partners generate some business and provide value to their customers too. Rich, thank you so much. I appreciate you, my friend.
My pleasure. Thank you all very much.
Appreciate you guys. Have a fantastic rest of your day and a wonderful Valentine's Day weekend, and we'll see you right back here, same time, same place. Have a great weekend, everybody. Bye now.